Welcome to the Deep Dive.
Good to be here.
So today we're really digging into Alex Becker. You know, his strategy, the whole psychology behind it, and his market impact, which, let's face it, is pretty undeniable.
Yeah, you really can't ignore it. He's definitely loud.
Right. So our mission here is to break down his playbook, what he's buying, why he's buying it, but also tackle that relentless controversy that seems to follow him everywhere, the reputational risk.
Absolutely. And to really get it, you have to understand the world he thinks we're in right now. It all starts with his core thesis, the crypto supercycle.
The banana zone.
Exactly, the banana zone. He thinks we're in year 4 of this repeating pattern, like 2013, 2017, 2021 before it. And the idea is that trillions, literally trillions of dollars are about to pour into the market.
Okay, but is that just hopium or is there something backing that up?
Well, he points to some quantitative stuff. The big one is the M2 money supply.
The global money supply metric.
Right. And apparently it's shown a really strong correlation with Bitcoin's price historically. We're talking like 92% correlation.
Wow. Okay.
So the argument is pretty simple.
Yeah.
More money printed globally means more flows into assets like Bitcoin. And that's the macro win pushing his $180,000 Bitcoin target for this cycle. That's the backdrop.
So a rising tide lifts all boats kind of thing. But Becker's angle on how to actually play this rising tide is different. He talks about social arbitrage and narrative trades. What does that actually mean in practice?
It fundamentally means he thinks traditional analysis, like looking at tech or financials, is basically useless right now.
Useless, completely.
In this phase, yeah.
Yeah.
He believes things like utility, revenue, balance sheets, they're just not what drives price.
Yeah.
He famously brought up helium in the last cycle.
Oh, yeah, I remember that one.
Right. Hit a $5 billion valuation
Right.
while making something like $6,000 a month in revenue. Totally. The value was all story, all hype, all narrative. So social arbitrage is basically betting on the story that you think the crowd will buy into next before they actually do, getting ahead of the narrative.
Okay, that makes sense in a hype-driven market. But if trillions are supposedly coming in anyway, why the big rush? He seems to imply this is like the last chance for those crazy gains.
Yeah, that's the tension, right? The urgency comes from what he calls extreme market dilution.
Dilution. Explain that.
Think about the sheer number of new coins popping up. Back in 2021, maybe 1,000 new tokens were created each day, which sounds like a lot.
Yeah, already seems like a lot.
But recently, there was a spike where 90,000 new tokens were being created per day.
90,000, good grief.
Exactly.
Yeah.
So you've gone from maybe 20,000 tokens total a few years ago to potentially 20 million tokens now. When that influx of money comes in, it just gets spread so incredibly thin across all these projects.
Right, finding the needle in an exponentially growing haystack.
Precisely. Finding a token that can still pull a 100x becomes way, way harder. So his argument is you absolutely have to be early and you have to pick the right narrative, the one that could absorb a ton of that incoming capital and attention.
Okay, that dilution point really lands. If you need a narrative strong enough to punch through all that noise, you probably need some institutional backing, right? Which leads us perfectly into his big new focus, real-world assets. RWA.
Exactly. RWA is all about tokenization, taking real-world stuff, real estate, commodities, stocks, bonds, especially bonds, and putting them on the blockchain.
And the story here, the narrative, is the potential scale.
Yeah, the upside potential is the key driver. Right now, the whole RWA sector is maybe just over $14 billion market cap, which sounds big, but in crypto terms, it's kind of modest.
Right.
But the speculation, and this is what he's tapping into, is that this could easily 50x, maybe even 100x, just this cycle alone.
And that's not just crypto bros saying that, is it?
No, and that's crucial. You've got traditional finance stepping in, like BlackRock managing $10 trillion. Their CEO, Larry Fink, has literally called tokenization the next evolution or next step for financial markets.
Then BlackRock says jump.
People ask how high. Yeah. That kind of validation gives the narrative serious legs and attracts serious capital.
So Becker sees this TradFi interest and jumps in. What's his take?
He's super bullish, called RWA super underrated, and claimed it was, and this is the quote, the easiest and surest 10 to 30x in crypto. High conviction stuff.
Okay, so he's talking the talk. Is he walking the walk?
Yeah.
Any specific RWA plays linked to him?
Yep, we saw it clearly with a token called Pin Link. He announced he'd taken a position, sure, but he also partnered with them, said he was going to consult advise their marketing.
Ah, the advisor angle.
Right. And this was after they'd partnered with Parallel AI, which is another project he holds. Then he tweets about it, calls it RWA, good as easy play.
And the price.
Popped Pretty much a clean 2x, almost immediately after he signaled his involvement, shows his influence.
Definitely. Any others in RWA?
He also mentioned Lumia, said it's looking really good.
Yeah.
And its focus is, again, institutional-grade access to RWA. Fits that narrative, perfectly bridging TradFi and crypto.
Yeah, so RWA is the big, maybe safer institutional narrative play. But a lot of his reputation and maybe his returns come from the wilder side of crypto, right? The low-cap altcoins.
Oh, yeah. That's where the really explosive asymmetric bets are. We're talking AI, robotics, and this thing called DePIN.
DePIN.
Decentralized physical infrastructure networks. He simplifies it as like Uber for GPUs or for other hardware, sharing computing resources, that kind of thing.
Got it. So AI, robotics, DePIN, these are his core playgrounds for finding those potential moonshots.
Seems like it. He dives into these mid-cap, often low-cap projects. They typically have very low liquidity.
Which means
Huge volatility. A little bit of buying pressure or his audience coming in can send the price flying. But the reverse is also true. They can crash hard and fast.
So give us some examples. What's he been backing in this high-risk zone?
Okay, well, there's Qubit. It's a quantum-safe cryptography project. Tiny market cap, around $13 million when looked at. How did he signal he was in? Not a big announcement, just replying to tweets about it with that, "You son of a bitch, I'm in"
Meme.
Huh, subtle. But his audience knows the signal.
Exactly. For a project that small, even a meme reply from him is huge news. Then there was ABM. He called that a hot new coin. Again, noted for its low market cap, maybe $24 million fully diluted at the time.
Okay, but what happens when these things inevitably dump? Because low liquidity cuts both ways.
Right, and that's the real test. Look at EMDR, or modular. It's in the robotics niche. This thing took a brutal hit, dropped over 80%, went from maybe a $45 million market cap all the way down to $2 million.
Ouch, an 80% drop. Most people would panic, sell, and run.
Most would, but Becker. The sources say he talked with the team during the crash, and what did he do? He doubled down. His take was that it was just oversold because of the bad market and low liquidity.
So the crash is actually a buying opportunity in his view, if you believe the narrative.
That seems to be the philosophy. If the core story is intact, the massive dip is just shaking out weak hands. He argues these microcaps will tank hard in rough conditions, but that's the price of admission for potential huge gains.
We saw something similar with OVP too, right? There was some FUD, some negative news.
Yeah, an expose questioned one of their partnerships or something, caused a big pullback. But then the founder addressed the FUD head on, apparently quite effectively, and the token bounced back strongly.
And Becker's reaction.
He basically used it as an "I told you so" moment, pointed to the poor panic sellers who got scared out right at the bottom just before it recovered, reinforces his hold through the terror message.
Which brings us to risk management, or maybe the lack thereof. If an 80% plunge is just noise, what's his actual advice for people following him into these coins?
It's notoriously blunt. Essentially, turn off your brain and just hold.
Turn off your brain. Seriously.
That's the phrase often attributed to him. He argues that capturing those 10x, 20x type gains means you have to endure periods of extreme fear and volatility that most people simply can't stomach.
So the volatility is a feature, not a bug. It weeds people out.
That's the framing, yeah. If it were easy and comfortable, the opportunity for massive gains wouldn't exist because the price would already be much higher.
It's a compelling, if terrifying, strategy. Okay, this obviously generates a ton of attention, a ton of noise, but we absolutely have to talk about the other side of the coin, the controversies. They seem constant.
They really do. But before diving into the negative, it's worth just quantifying his influence again. It's kind of staggering.
How staggering? What does the data show?
One analysis looked at tokens he recommended specifically on his YouTube channel. On average, within just 1 day of the recommendation, those tokens saw a price jump of nearly 21%.
21% in 24 hours, just from his mention.
Yep. While Bitcoin over the same periods actually dropped slightly, like 0.3%. So it's clearly his influence moving the needle.
And longer term.
It gets even more dramatic. Within 14 days, 2 weeks, the average gain for those recommended tokens was 100%, a clean double.
Doubling your money in 2 weeks if you got in early. Wow.
Exactly. So you see the power. That level of influence is immense, which probably explains why he attracts so much scrutiny and why the stakes are so high.
Okay, so the influence is undeniable, statistically proven. But let's pivot to that scrutiny. The counter-narrative is pretty harsh. What are the main allegations?
They're quite serious and varied. Some critics claim his whole model relies on finding followers who, quote, can't think, and that he leverages them. There are also persistent claims about him getting paid hefty sums, like up to $150,000 per project, to be an advisor.
The classic paid promotion concern, but with large numbers attached. What else? It goes beyond just crypto promo, right? His other businesses.
Yes, definitely. There are significant allegations tied to his software companies, specifically Market Hero and Hyros. Claims of refund scams pop up frequently in criticisms.
Refund scams. And Hyros has that sort of opaque high pricing starting around $4,000 or more.
Right. And with Market Hero, there were specific complaints about mandatory credit card trials, with critics calling it a tactic to get people onto recurring charges they might forget to cancel, basically profiting from inertia or lack of attention.
That sounds ethically questionable, if true.
It certainly raises red flags for critics.
Yeah.
And adding to that, there are claims that his legal team actively works to suppress negative reviews or complaints from people who feel they were wronged by these practices. Suggests a pattern of aggressively defending against consumer issues.
Okay, so that's a significant cloud hanging over him from the sauce world. What about the most direct crypto accusation? Market manipulation, pump and dumps.
That's the big one in crypto circles. The analysis on one specific trade, Alura, is interesting here.
What did it show? Did he dump on his followers?
Well, he did sell his position about 11 days after recommending it, and yeah, it was near the peak price, so the timing looks suspicious on the surface. But the analysis also found he held a tiny fraction of the total supply, less than 0.1%. And crucially, the price where he sold roughly matched the $200 million valuation target he had publicly stated beforehand.
So the counter-argument is he was just executing his stated plan, hitting his target, not necessarily orchestrating a dump with a huge bag.
Exactly. It muddies the waters. It wasn't a clean dump in the traditional sense of unloading a massive hidden stash, but the timing combined with his influence still raises questions for many.
Which probably explains the mixed results people report having by following him.
Precisely. You hear stories from some followers claiming amazing gains, 300%, 500% on certain calls. But then you absolutely hear from others who lost significantly, likely on those volatile low caps that didn't bounce back quickly or that they bought too late. It's a high-risk, high-reward game intrinsically linked to his controversial profile.
Okay, so summing this up, we've got this picture of a trader making huge, bold, asymmetric bets. He's focused on narratives like RWA, AI, gaming. He's got macro indicators like M2 supply, potentially backing his cycle theory. He demonstrably can move markets, doubling token prices quickly.
Yep, that's the bull case, the power he wields.
But operating constantly under this really heavy cloud of ethical questions, business practice complaints, and manipulation accusations, a dual reality.
The very sharp duality. But there's one more piece that ties back to that dilution point we discussed earlier. It's about Becker himself.
How so?
His own focus is getting diluted. The sources suggest he's currently tracking something like 72 different tokens in his portfolio.
72. Wow, it's a lot to keep track of, let alone promote effectively.
And it's predicted that number could grow to maybe 120 tokens by the end of this cycle.
120 projects?
Think about it. If his main edge is social arbitrage, focusing his massive audience's attention and capital onto one or a few specific projects to ignite them, what happens when that attention is split 72 ways? Or 120 ways?
The impact per token gets much, much smaller. His superpower gets diluted.
Exactly. His leverage, that ability to inject energy, isn't infinite. Spreading it that thin has to reduce the impact on any single recommendation.
Which leaves us with a really interesting question for you, the listener, especially as we navigate this cycle. Considering the massive dilution happening across the entire crypto market, those 90,000 new tokens a day.
Yeah, the sheer noise.
And now the potential dilution of even the biggest influencers' focus, like Becker spreading himself across maybe 120 tokens. How sustainable is that social arbitrage model, really? Can narrative and influence alone keep generating those life-changing returns in such a saturated, noisy environment?
Or will the sheer scale of the market, the overwhelming noise, finally start to drown out even the loudest voices? Will things be forced back towards, actual fundamentals and utility just because the hype game becomes too diluted to play effectively?
Something to definitely think about.